What's up? More Than Mortgage, episode 31, right here on YouTube, Facebook, Instagram. I don't know, somewhere out there on the internet where they allow. I'm Chad Anderson. This guy here is Zach Jones. Hope you guys are doing well. Zach, how are you?
I'm doing good. I'm going to get my microphone out here in front of me like we're doing business. I'm good. Having a good day today. How about you?
Yeah, you a little late on your show prep there or your equipment prep?
Yeah, I'm just faking my way through it.
Well, you say that, and then I lose camera.
I was
So
about to say something about that, but
I'm over here mocking you, and then my camera goes out. That's
I've
awesome.
got a face made for radio on that one.
That's always been the case. Like the only people that would hire me for TV is my own YouTube channel. So, all right, there we go. Back with the wrong setting. I'll try to get this squared away. I had some trouble. There we go. Setting it up at the beginning, but I don't know. I don't think we're like Joe Rogan and the mothership where they're listening to us and trying to like cancel us or knock us offline. I don't think we're that important. So we'll go with technical user error on something like that.
We're safe on all those fronts, Chad.
Yeah,
and when we're not safe, I'll take the hit.
All right, appreciate you. So today we want to talk about appraisals, and this is something we kind of brought it up last show. Like, had to think about it. Have we had an appraisal discussion? And when we went back and thought about it, we did talk about appraisal gaps, and what that means is that, hey, what we had happened before and what could happen in the future if rates dip and there's still a huge demand issue, supply demand issue in the housing market, that you could have situations where house prices go up again significantly, but the appraisals, like the comps in the market, don't catch up for a while. And therefore you've got a gap, meaning you've got someone willing to pay more for a home than what an appraiser says it's worth. So go back on the channel, check that one out. It was a good episode, a lot of good information. But today I'm going to throw kind of some fastballs at Zach, and we're just going to talk about some of these different topics. And some of them are myths, some of them are true, some of them are things people should just know. But one of the top ones, Zach, and I'm going to let you just kind of explain this one. It's more of a why, but I got this one the other day. I probably get it a couple of times a month. I'm sure you get it, but people say, oh, okay, cool. I know this appraiser. He'll be able to come out and knock that report out. No problem. Or my friend's an appraiser. My cousin's an appraiser. I can get them over here and we can get the value taken care of for you and send it to you. Just 100% can't do it. But go back to, because you've been in the business. I was coming into the business right at the HVCC rules. You were a part of that fun time in mortgages, but kind of go down like just the policy or the compliance piece of it, like why. It's pretty obvious once you say it, but explain the why behind all of this.
Well, kind of a real quick history lesson. I learned the business in 2003, 2004. And so that was, way back in what I call the cowboy days. And I had to get into the business on the broker side because the banks wouldn't hire you. The big lenders wouldn't hire you unless you had a couple of years of experience. And so I came in on the broker side, and it wasn't uncommon. We had our own panel of appraisers. I can remember meeting the appraiser in our office that our office used primarily. And back in those days, you could literally call an appraiser up and say, hey, listen, I'm doing a refinance on this house at 123 Oak Street. Can you take a look at it and tell me whether you can get, I need a value of $250 to do this cash out refinance. And he would, call you back. This was really, we weren't even really texting back then. So here comes the call, says, man, you're good on that value.
Were you on the Crackberry back then?
No, it was all flip phone. I wasn't highbrow enough to do the Blackberries. When I started, honestly, I had a beeper.
Okay.
I was working. I was probably 4 years into the business before I actually had a cell phone. So it was interesting times. But he would call back and say, "Hey, you're good at 250, and send me the order if the deal works. If you can get the loan locked." And that's the way we did it back then. And so we would. It sounds crazy now to think that we could kind of shop around for value like that, but we called it a pre-appraisal or a pre-valuation. And it was common practice because there weren't any standards beyond the professional licensure for the appraiser and, what we were doing in the mortgage business. I never asked anybody to get me a specific value that was unreasonable, but there was a lot of back and forth and a lot of conversation, and it was very open, collegial kind of cooperation in between those entities, between the lender and the appraiser. Now, other people were pressuring appraisers, saying, "Hey, listen, I'm not gonna. You're gonna have to give us the value we ask for, or we're not going to do business for you." And so the appraisers were running scared and feeling muscled by mortgage companies and brokerages and little individual mortgage companies. So that was where things got sideways and got into problems. As you can imagine, wherever there's, an inch, people will take a mile.
No.
So do what?
No, never believe that.
Yeah. So fast forward, now we're in an age where there is a strong layer of insulation between lenders and appraisers. And there's probably, Chad, I always think it's better to have a thicker layer of insulation there than a thinner layer of insulation. There is some room for conversations with appraisers, but we can't ever talk about value. So there's now kind of been this balancing of that collegial back and forth. I can't say that I've had conversations directly with appraisers about a particular property, but I have had a couple of occasions where I needed to contact the appraisal management company who's in charge of the appraiser to make some inquiries about this or that. So there's a little bit of room for cooperative kind of conversation, and everybody wants to do the right thing in the industry. But there's not that old kind of pressuring and kind of open season on value that we used to have. And there's also where that kind of ends, that any of that cooperative conversation ends, is when you get into a situation where you're trying to shop value. So if you get an appraisal that doesn't quite make value, you can't just go order another one from another appraiser and see if you can get the value.
Yeah. All right. So, and that's such a good point, because that question comes up every time. And I want this to be so loud and clear. Like literally, if you're a video editor, edit this 20-second clip and just post it and boost it and pay $1 million to broadcast it all over the internet. Lenders never want the appraisal to come in low. So it's funny because as soon as it happens, lenders get attacked. Your appraiser. Wait, not my appraiser. They're not employed by us. It's selected at random from a panel because of all the reasons Zach was just describing. The worst thing that could happen is it come in low, because you do all this work and then the buyer could potentially not get the house. The seller could potentially not sell the house. The realtor could potentially not get paid after a bunch of hard work and have to start over. The lender could potentially not get paid and have to start over. And at the end of the day, somebody still has to pay the $500 to $700 for the appraisal report that was completed. And imagine trying to tell somebody to swallow that frog. Okay.
Like bad news for everybody.
It's awful all around. So nobody wants it. But like Zach said, the question of, well, let's just order another one. That's not an option. You don't get to play appraisal roulette until it lands on your number with an infinite bankroll over here at the casino. It's not how the game works. So I'd like to make sure people understand that, keep that in mind, and how that process works. Second, appraisers get a contract. It's $500,000 purchase price. They'll never admit it in concrete, in writing, whatever. But appraisers, I'm not dogging them for this. I'm just saying, this is part of the whole regulation thing. More times than not, even if a value could be 510 or 550 or 530, it's probably, I would say, 2% of the time, and I'm just spitballing here, that the appraisal comes in above purchase price. A lot of times, if it comes in above purchase price, or it could come in above purchase price, the appraiser just hits the purchase price. Explain that one, Zach, because that one comes up, quite a bit. I've actually had customers who bought a home. They think they're getting a deal, and then it appraises for the purchase price. And they're like, it should have appraised for 50,000 more. I don't understand.
I think it's the safe play, Chad, honestly. Right. And so what I've become accustomed to explaining to people is that if we get an appraisal back, if you get an appraisal on a $500,000 house comes back at 512, I'm looking at that client and at my buyer's agent saying, if they came in at 512, that probably is suggestive that there's a lot more value there and they're playing it safe because they've got to defend their work. Right. At multiple levels. They've got to defend their work, number one, for their own personal integrity. They've got to defend it with the AMC. They've got to be able to answer any questions from the lender. And ultimately, that appraisal follows them around with some, semblance of liability attached to it in the event that the loan goes bad or there was fraud or there's foreclosure. They come under scrutiny because they're the one that provided the value. So, and likewise, on the other side of things, if you have an appraisal that comes in at $494 on that $500,000 contract price, I'm looking at my buyer and saying, listen, I know I can see that guy over there pulling and stretching on that value, trying to get it up to $500,000 and just couldn't make it. So that, and again, it's a point of, how do I defend my work? Because they are the ones ultimately that come under scrutiny if there was a bad job done in the valuation.
Yeah, that is really the answer. And people can't believe that's the answer. But it really is. It's the safe play. Appraisers have to answer certain compliance or licensing or regulation or code just like we have to. Just like realtors have to. If things come up, if there's enough red flags, and here's what people don't understand. Fannie Mae, Freddie Mac, and FHA, VA, like they all have so much data on houses based on zip codes and the market and the metros and just kind of everything. They run these things called AVMs, automated valuation model. They have these what's called SSRs, which are scores and grades based on, hey, this house and the value that you submitted really sticks out like a sore thumb. And it could stick out high or low based on what we see in this census tract, in this demographic, in this area of town, in this city, in this state, in this area of the country, whatever it is. And so appraisers have to answer for that if they get too far out of whack. So the safe play, and it could be they just simply don't want to answer the damn questions. They just don't. Like, they're like, look, it hit value. I don't care. I don't, like, what does it matter? Right. I'm going to lead you down a path here and see if this is something that you agree with and kind of go with. I kind of have this stance, and I talk to people and I say, you know what? It really doesn't matter what your home is worth today. Like, think about that. Like, to me, appraisals have become this thing in society where people drum it up in their head that it's so important. Right. But equity is something that you don't get to touch. It's invisible. You can't touch it. You can simply open up a screen and see maybe what Zillow thinks your home is worth. And then you look at your balance on your mortgage, wherever you bank, and you're like, okay, well, I can do X minus Y equals Z. And that's how much equity I have. But you can't touch it. You can't spend it. You can't do anything with it. Like, appraisals truly, even when you're buying a home, as long as it hits the purchase price, it literally means nothing until you either want to refinance or sell the home, right? Like, how do you talk to customers about that? Because I get that one a lot. And I just have to remind them, hey, it's not public record. No, like literally, if you bought a home and wanted to refinance 6 months later, the new appraiser won't even know other than the purchase price, but nobody will actually see the appraisal report itself. They just see the purchase price and the mortgage. That's all they see because that's public record. But an appraised value is not.
It's in my mind, Chad. You brought up Zillow and the Zestimate, which is totally meaningless. It's a neighborhood of value, but I liken it to the tax assessed value. people will call me and say, hey, my tax assessment just came back and it's, $112,000 less than what I paid for the house last year. I'm like, good for you. And they're like, no, but wait a minute. Didn't they see my appraisal? I'm like, no, they don't see your appraisal that you got when you bought the house. And number two, you don't want them to tax assess your house at the full market value, because that just means that you're paying more taxes. Correct. So, you want your $500,000 house to appraise on the appraisal report at 750, and you want it to appraise for 132 at the tax assessor's office. And that's about how meaningful they are. It's just kind of like, what's important to you at the moment. I want low taxes and I want high value. And Chad, I think maybe that's human nature too. It's like looking at your stock portfolio or your 401k. It really doesn't make much of a difference until you're getting down to retirement planning and pulling those investments down into a more conservative kind of income producing entity.
Right.
Before that, you can go up, down 20%, 30%, crash, boom. It doesn't really matter if you're playing the stock market game. It's a long game. So that's always the play on equity. It's kind of it's a feel good.
Yeah.
Unless it goes the wrong way.
Yeah. It's nice to brag about whenever, in 2020 and 21 and 22, even today, people brag about the equity and it's great.
Yeah.
Doesn't matter. You can't touch it.
Right.
You can, but you got to sacrifice your low rate in order to touch it.
It doesn't really change anything about the house that you live in. You're still just living in that same old house. And if you're at my house, the washing machine went out yesterday. That how much my equity is doesn't matter. I got to get a new drain pump for my washer.
Yeah. Either way, you're getting the drain pump, man. Either way.
Right.
Let's talk about actual programs. So go over real quick. Conventional, that's the most lenient. It's kind of a free for all.
Yeah.
A free for all in today's standards, not like the Wild West of before. FHA, much more strict. Same with VA, more strict. But there's a difference, and I know you'll go into this. There's a big difference in FHA and VA, because I still don't understand why the balloons show up. There's something to do with gestures. Yeah. So VA, though, they at least work with you in a way. I'll let you explain. FHA and conventional, if it comes in low or there's something wrong, there's an appeals process. But I'll let you run through those three programs real quick.
Yeah. So conventional probably is the most lenient overall from a valuation and a property condition perspective. They're not real picky about a lot of details, although there are some kind of hard and fast things. If the house has any evidence of water intrusion, or, I've seen people get real picky about electrical issues. A house has to be in good habitable condition. And I always tell people, Chad, this has kind of become my line, that good habitable condition on an appraisal means different things to different people. If you're a handyman and a remodeler with a contractor's license, then good habitable condition could mean a house that's taken down to studs and just has functional mechanicals. Yeah. And you're going to go in and do everything to that house. But a newly graduated nurse, 23 years old, good habitable condition means that she's got to have the quartz countertops and the LVP floors and the full tile baths. And so good habitable conditions is wide range. And what I usually tell people when they're considering an older house is good habitable condition on a conventional appraisal is if you can go in there and fix what's wrong with that house with a steam cleaner and a few gallons of paint, we're going to be good on the appraisal. But if you've got to replace flooring, or if there's brown stains in the ceiling in the back bedroom, the evidence of a leaky roof or whatever, then we could potentially have problems on that appraisal report. You go into FHA has some pretty strict guidelines about certain items that may need, they would fall maybe into a deferred maintenance kind of category. But FHA is, man, they're so picky about rails on stairs, on steps. the thing that I see most commonly on FHA loans is peeling paint. So if you have, it's going to be on the windowsill invariably. I have had several buyers and buyers agents go over to houses and paint the windowsills after that came up on an appraisal because there's peeling paint. That's where the water kind of settles in. That's where the sun beats down relentlessly on the south side of the house. And the paint's peeling, even though it was painted 3 years ago. That's a no bueno on FHA loans.
FHA and VA too, as you go into that, there's two words that come to mind that I always talk to clients about: health, safety. That's really your litmus test, health and safety. And the peeling paint is one that does come up all the time. Window seals. I see it on decks, on the back deck. You see it on the back door, around the siding, around the door frame.
Little rot down there at the bottom where the rain kind of seeps in under the frame. Yeah.
Old front porches that are like the almost wrap around, but it's a full on front porch, but there's no rail on the front of the porch because it's just kind of a step down. So then it's discretion if that's a health and safety issue, because you could fall off and break your ankle or your neck or something. But continue with VA. Sorry.
So VA, I'm going to jump off a condition a little bit. Maybe we need to come. You might want to say something about condition on VA, but I'm going to come back. I'm going to jump back and get on about value.
Okay.
So are you okay with that? Moving on to that?
Yeah.
Because this is one of the big differences that I see in the industry, and there's such a strong bias against VA loans. There's a ton of myths about it, but things come into play with the appraiser about value in VA loans. Maybe an antiquated system. We order all of our appraisals through the Veterans Administration, so those are not even individual appraisers that work through our AMC or our appraisal management company. That you have to go directly to VA to order those appraisals for a VA loan. So on a conventional and an FHA loan, we're going to receive a report that has a valuation within a delivery expectation. Appraiser goes out, inspects the house, sends us a report, and has a value on it. Yep. Now, if that value is short, Chad, that's where the problems start, because now we've got to go in and start asking for a reconsideration of value after the appraiser has already established the value of the home and has done comps. So we have to go to the listing agent, get comparable sales, get a list of items that they believe that the house is worth more than it's being valued at. Here's the comps that we use, and then we can't, it becomes kind of a back and forth. They want to then contest the value if it doesn't come back the second time. When I always tell people when I'm in a situation like that, which is not really very often, but you don't want to try to go back and forth. You want to put your best foot forward one time. You do one consideration of value, give the very best comps, and move on. Had a situation recently where I went back on it was a conventional loan, and the agent said, well, I don't really have any comps to value this property, but we know it's worth what we've contracted for. Yeah. And that's a real problem. It's a real problem, because I do believe that they felt like the value was correct. They'd made price adjustments and they tried to support that, but it had been on the market for a little while. It was in a unique area. It was a really kind of a property that was boxed in by some weird circumstances in that particular area. And it was just a struggle. We did ultimately work that out. But it can be a lot of back and forth. Now, let's compare and contrast the back and forth of that, which is kind of it's contentious at best, as they're offended and they got egg on their face and I'm trying to defend my value. Well, I'm trying to defend my report. I'm trying to defend my value. Well, you're wrong. Go over to VA. VA has this amazing system that I wish everybody would adopt, and they call it Tidewater. Yeah. So the Tidewater, when a VA appraiser invokes Tidewater, we have ordered the appraisal, they've gone out and inspected the house, they've come back to their computer to do all their work, and they say, hey, everybody, I'm invoking Tidewater. So they wave this big flag, and the flag says, I'm struggling in my initial view of this house scenario. I'm having a problem finding value. So please help me out and send me all of the comps that you have for the valuation that you used, and help me to understand how you arrived at the value. So it's kind of, it's kind of like a public hearing. They're soliciting information. Chad, we lost you if you don't know that that's going on over there.
Thank you, though.
So that is the very best system, because the appraiser has not established a value. There's no defensiveness at all on the appraiser side, and that's the guy that we want to keep in neutral territory. I need for the appraiser to be Switzerland until we have all of that information in, and so then we, in a very cooperative way, push that information over to the appraiser, and the appraiser says, thank you very much. These are things that I hadn't considered. I didn't see them in the system. Thanks for the information. And then they come back with a value. So it's instead of, establishing a value and then everybody digging their heels in and getting entrenched in their position, it's a much friendlier way to do things. I had a situation, the only VA loan that I've had that it had Tidewater probably in the last 3 years was earlier this spring. And the listing agent didn't understand it at all. He really just melted down about VA appraisers, VA buyers, VA loans in particular, the whole VA system. I mean, the guy wasn't even a vet, and he was having more PTSD than most combat vets have about their combat experience, just about the value coming in a little bit short and invoking Tidewater. And it's in large part because he didn't have much to defend his value. We did work that out, and the loan ultimately closed, but it wasn't worth. I mean, the guy was literally screaming. So we worked through that, but I think more than anything, he's a victim of the mythology, the negative mythology around VA loans. I love VA loans. They're easy to underwrite. They're generous to buyers. You don't have to worry about sourcing funds for a lot of them. There's a way to do VA loans where the buyer gets their earnest money back at closing. The appraisal system is really very friendly. A terrific loan program, but it suffers under a lot of bad old ideas, I guess. I don't know. It's just like prejudice and bias.
So last thing to wrap this appraisal topic up, this is more forecasting. Where do you see appraisals fitting in the future? Because everything's, I mean, we look back 30 years, right? And I wasn't a part of this, but used to, from what I understand, hand applications, and you have like the 3 layers of paper, and you're overnighting the documents to the underwriter who's somewhere else, and
stacking the file, or they won't accept it.
Yeah, you're doing everything right. It's just old school. And then they slowly, kept building some technology, and then you have DU and LP and these automated underwriting systems, and that was going to eliminate underwriting, which didn't happen. Then people were talking about, we're going to eliminate the loan officer because of tech. We're going to eliminate title companies. We're going to eliminate the appraisers. As technology advances, everybody worries about their own job. Appraisers, are they susceptible to that? Or what do you think the future looks like? Because we've, again, even though we've had technology, mortgage industry is weird, man. Like, there's just so much red tape and regulation and everything. I'm not saying it hasn't gotten easier to get a mortgage, because it is. It's significantly easier than it used to be. But there's still 20 different hurdles and hoops and departments you have to go through, or third parties that you have to work with. And it's real easy to name for anybody who's shaking their head right now. I'm just curious your thought on the future of appraisers. Because it's also, real quick before you answer, it's also an industry that is dying off. Like, the average age of an appraiser is like 55 or something. Like, because it's not cool to be an appraiser. They're not like
It's not a
beating
fun
down
job.
the door, right? They're not beating down the door to go to appraisal school. So, and the barrier to entry is significant.
Right.
You have to
It
spend
is.
like 2 years in an apprenticeship to be able to get qualified to be an appraiser. So anyway, I'll let you run with it now, but I do wonder about the future of this side of the industry.
Yeah, you know, it's an interesting question, Chad, because you can look at our industry as a lending industry and say there are definitely pieces of our industry that are going to be replaced by AI, but they only go so far.
Yeah.
And then you run up against a wall. For instance, I could see Fannie Mae and Freddie Mac adopting a policy once the artificial intelligence engines for automated appraisals get sophisticated enough where they say no appraisals needed for loans that are 60% loan to value or less. And we're gonna run it through our automated appraisal system, and or our automated value system, and we're gonna just let it go. I don't know how long it's been since you've seen an appraisal waiver, but they are scarce in my
They're
pipeline.
more scarce. I actually have 2 this month. So
Well,
bad person to
anomaly
ask,
though.
but yeah, bad person to ask for your example. But you're right. I mean, one of them's also a refinance that's at
Okay.
like 65% loan to value.
Right.
And the other one is a purchase with 20 or 25% down.
Gotcha.
In a very populated area as well. Also, excellent credit, lots of reserves, the whole thing.
High data, high quality loan.
Yeah.
I used to see them, fairly regularly until maybe a year and a half ago, and they just seem to have trailed off. And I don't know if that's a market condition, if they changed the algorithm, or it's just me doing my business where I'm doing it. But I think that there will be a degree of the appraisal system that will be replaced, but you can never accurately value a home at its full maximum value with zero risk on a data based model. You can't take into consideration the improvements. You can't really understand the uniqueness of a particular property in a particular area. You can't take into account that that 1930s farmhouse has been completely redone in the last 3 years, and it really was worth $238,000 3 years ago, and now it's 1.3. You're
Yep.
never going to be able to value that house at 1.3 on a data model because you just can't understand the amount of money that's gone into it. So it really is. It's very interesting to watch that in our business. There are some functions in our society, Chad, that I'm really gravely concerned for with regard to AI and just being able to, if you were writing legal opinions and that was your thing, maybe that's one of those things where the AI's access to uh, a whole internet full of case law is going to eliminate the need for that because it's maybe the subtleties aren't such that you still value humans. Maybe there's a human editor in that, but there's not a bank of attorneys that are doing that, for 70 hours a week in the back office trying to make partner. I don't know how all that's going to go, but there are some vulnerabilities in appraisals. I can tell you that it would be a good profession to get in if you could sustain the rigors of starting out. It's a little bit rough right now because it would be hard to find. It's hard to get into it because when business is slow, the appraisers don't want to take on an apprentice, and when business is hot, there's no time to teach anybody. So it's a really weird position. It's a weird profession.
It really is. I will say this is one positive on appraisals. As far as like the PIW, which is a property inspection waiver, I've actually seen them on new builds, which used to be a never.
That's weird.
Never see it. And I
Yeah.
think we've seen like 3 this year. So
Wow.
they expanded a little bit, which is interesting. They said, "Hey, we're willing to do this on a new build.
Right.
We just need to verify it's complete," which you get a CO, a certificate of occupancy, from the builder at closing. So that verifies that because it's issued by the county in most places.
That's crazy.
But I've actually seen that. But you're right. The traditional real estate, you don't see it pop quite as often as it used to. And it's kind of interesting how they, expanded the opportunity for waivers over here, but then reduced on the other side. Just, I don't know. It almost makes you wonder, did they think values got a little overinflated, even though the data says otherwise, because home values keep appreciating right now. So I don't know, but just more speaking out loud and throwing something against the wall. But yeah, I thought that was interesting. But anyway.
Well, I hope this has been helpful. It's a good discussion, and it warrants, there's a lot of education to be done about appraisals.
It is. Appraisals is one of those things that like nobody really understands, just like credit reports. Maybe that's another one we do at some point, because it's one of those things that it's such a key component of the mortgage industry and the housing industry, but people just don't know anything about it. And they only know the surface level, or they only know what seems like common sense, but really it's not, because there's all the intricacies that go into it. So, it is a good topic, one that the general public will never fully understand. And there, honestly just becomes an element of trust, or you just have to believe us and go with it because currently it's part of the industry and is what it is. But all right. If you guys can help us out right here, follow us, YouTube, Instagram, Facebook. See over there, Zach Jones Loans. See right here, this chat is real. Appreciate you hanging out. 31 episodes in the books. We'll be back next week. New topic, same us. Hope you have a great week, and talk to you soon. See you guys.
Thanks for joining us.